If you were starting from scratch today, the question is to both of you, and could only invest in one layer of the AI value chain, but NVIDIA, Microsoft, Amazon, Meta, and Alphabet were off limits, where would you allocate capital and why?
So we invest across the value chain, and my favorite area is networking. That's where there's a lot of change happening, and optics is becoming a really big component where it used to be used only in scale out in terms of connecting different data centers and connecting the data centers to the outside world. Now we're going to see a time where it actually finds its place inside the servers, so for scale up applications. So I think that's one area that I would highlight as not necessarily under the radar because those stocks have started moving as well, but it's a little bit earlier in the cycle than things like memory that are supply constrained right now.
Why is that a specific area attracts your attention? What do you think are interesting long-term drivers for that? And what do you think is the size of opportunity given the other parts of the AI stack?
So what we do a lot of is analyze the supply demand. As Paulo mentioned, these segments are very cyclical. So it's all about how much supply you have at any given time and how much demand there is for it. So right now, the demand side, it's not necessarily the problem. So we know it's going to be there. There are a lot of data points pointing to a big step change in demand. So, and that applies to everybody. Everybody is going to see the same benefit from demand side.
How big?
So what we've been hearing right now with this agentic AI wave, the demand is coming out about 3 times the prior model training wave. So if you look at the order books from the Dells of the world, the HPs of the world, the model training era was a big step change. And now we have a 3 times change from that. And this is why you're seeing Google come to market with a offering, right? Exactly. Basically, like in the prior cycle, the model training era, if you will, companies were able to fund it all from cash flow. So basically, they would just spend their entire operating cash flow on CapEx and this build out. Now we are entering a phase where cash flow is no longer going to do it. And it kind of ties into the numbers, right? Basically, we think it's going to be about 3 times as big. So if they're generating 100 to 200 billion in cash flow, now they're going to need something like 3 to 600 billion. So hence the $100 billion race for this next cycle.
One thing, was reading this very good note on the sell side. Cyclical industries, there are 2 types of bubbles. There is a earnings multiple or revenue multiple bubble, where that multiple goes out of whack. And then there is a different type of bubble driven by the earnings being super high, much higher than average, much higher than return on invested capital would say they would get. Industrial companies like mining companies often go through not through the multiple bubble, but rather through the earnings bubble. For example, when I used to be in the public markets, what's the best time to buy iron ore miner is when the multiple is the highest, not when the multiple is the lowest. Because when the multiple is the highest, it's probably the bottom of the cycle. And from there on, you're going to get a great return. When the multiple is the lowest, it's probably the end of the cycle. And that's why you should run away from that. Same idea with semis. Semis have historically been very, very cyclical. It's just that we're in a super cycle for semis that will likely extend at least until, call it 2030. I don't know. I have no crystal ball, but that's kind of the feeling I get. But at some point, people say, oh, it's very reasonable because the multiple is reasonable. Yes, the multiple is reasonable, but it's the number of years you're going to get that excess cash flow is limited. So even if you do that math and you get a return, great. But right now, the multiples on the cyclical things should be low, not high.
And that's why they are low, right?
Exactly.
So basically, memory is one that is like particularly cyclical. Yeah. So if you look at the value chain, basically different parts have different cyclicality characteristics. And it's really mostly driven by how they derive their revenues, whether it's through price or through volume. So some industries like memory, the price really fluctuates significantly. So right now, prices are up like 7x what they were last year versus you have other parts of the value chain that's not necessarily price driven. They will price mostly for value they add. So if you look at the semi-cap equipment names, for example, they can charge whatever they want right now, but they're not because they are trying to prevent that cyclicality. So I think depending on where we are in the cycle, it makes sense to, if you're very early in the cycle, you want to go for the very cyclicals and capture that cyclical growth. And I think we're now at a point where you want to be looking for alternatives and some areas where you may not have the downside if the markets were to turn. And semicap equipment is an example of that.
You ask a question, where should you invest now? We are very focused on the application layer because all the other layers kind of have already happened. What has not happened in terms of massive profits or companies that billions and tens of billions of dollars of revenue is the application layer because it's the newest one.
And
So-
the riskiest one right now, given all of this moves from the LLMs, right,
Yeah.
to a certain extent.
But this is why it's so interesting because the shallow view is Anthropic and OpenAI are going to do every single application layer better than anyone else that can come down the stream. And that's not at all what we're seeing. We're seeing companies that are focused on legal or companies that are focused on video or companies that are focused on some specific task, taking advantage of multiple models, orchestrating those models, adding data loops on top with the client's data. That's the stuff that is right now creating solutions that are easy to use and early signs that they're doing really well. An example of that would be Higgsfield. Higgsfield was launched more or less a year ago. Company went from 0 to almost 500 million of revenue in
You need
1
to
year.
explain what it is.
So Higgsfield is connected to 30 different video models in the world. And then they combine those models to create the best video for you. Most videos are created for the purpose of advertising, either on TikTok, Instagram, YouTube, etc. In the beginning, the go-to-market was mostly focused on consumers because those are the early adopters. Those consumers helped get the platform to produce 6 million videos a day. Those 6 million videos a day are tagged for performance in real life, which then feeds the algo to further optimize the video creation. Now, where they're going to really monetize is enterprise, not consumer, because the retention levels of consumer is very low, but the retention levels of enterprise is very high. So right now they're growing the fastest on enterprise, and that market it can be 50 billion of revenue. The biggest company being targeted by this type of players is Adobe. Adobe is the one to disrupt on this wave. And players like Higgsfield are moving way faster than Adobe. They have a very, very good talent, and they're just being very smart about how they're building their product without spending all the billions of dollars to train the models. The two best models in the world for video are obvious, is whoever has the best video data. In the West, it's Google with YouTube. And on the East side is ByteDance with TikTok. It's as simple as that. That's why those two models tend to be the best models. Of course, other people have interesting models, but those players that at first try to build their own models for video, they just got out of the race. Everyone is folding their hands in that way of going about it. They're basically saying, let's connect to everyone, let's optimize, because also video creation is extremely expensive, takes a lot of tokens, the budgets can get out of control. I find that kind of layer very interesting, because if you're an advertising agency and it used to cost you $1 million to create a really cool commercial, now it costs you $10,000. What you still need is a very creative person that can imagine what the commercial should be and can put that into practice. Those creative people are going to do extremely well with these tools, but the ultimate cost to produce the commercial is going to collapse. So I think I can go on in many other industries, but the same logic will apply.